Yes, as in, I think this is a classic big tech versus small tech story developing here. We have seen this before. We have seen this in many different pockets, particularly in enterprise, evolve as you take back Okta, you take back Atlassian, Shopify. These are just a few names that have kind of flourished under the shadow of big tech within a very small, innovative, disruptive sector. I think Slack is exactly that. They have a lightning in the bottle. They have a fantastic product market fit. They have focus on this specific niche of collaboration and chatting. I think there are a lot of things going on for them. I would point that Microsoft hasn't given out any engagement metrics. Slack has given them out very, very consistently. Pretty high significant number of paying users versus active users. Pretty active number of messages being exchanged. So I think I like Slack here. The shares are down 20%, while you look at Zoom and CrowdStrike, comparable IPOs, they're up 20, 30, 40%. The difference is it's a direct listing. I think there was no price stabilization, no underwriters. Also, on the flip side, there are no lockups, which I think all the price action around lockups, we have already seen that for Slack. So from here on out, we like the name.
I mean, I think that's an interesting comparison against recent IPOs, but those IPOs are in different industries, even if they are software companies. So I'm not really sure, in my view, if they're apples to apples comparisons. In terms of Slack, though, does it need to have a path to profitability for investors to get more comfortable with the story? Because that does seem to be sort of a trend within the IPO market right now. Investors are less willing to give the benefit of the doubt to any IPO, whether it be Uber or Slack, if there's no path to profitability.
There has to be a path to profitability. You're 100% right, Melissa. I think their guidance implies a hint of pathway to profitability. You take out a few numbers, you make a few adjustments, the cost that we had to bear to go public, so on and so forth, and then you see some leverage in the model. But we don't feel that leverage is high enough for people to jump onto the bandwagon that, hey, this company will be profitable in the next X number of months with fair degree of confidence. We would want to see sustained revenue growth if there is no pathway to profitability. So you can't have both. You can't have deceleration and losses mounting.
So they've got their first report as a public company scheduled for my birthday, September 4th, by the way. So I'm looking for a birthday present here, Rohit. What should people look for in that report in terms of directionality on that pathway to profit?
On pathway to profitability, we want to see that sales and marketing spend does not spike higher. We want to see that from a revenue standpoint, the biggest number that we would be focused on is annual run rate, ARR, coming from big enterprises. How is that trending? I think these two numbers, what is the sales and marketing outlook and what is the ARR run rate? What proportion of revenues are you getting from big companies like Microsoft and IBM and SAP? I meant to say SAP and Oracle. Scratch Microsoft there. A lot of that on my mind right now.